Welcome to Inside Economics. I'm Mark Sandy. I'm joined by my colleagues, Ryan Sweet, Director of Real-Time Economics, and Cris Dorides, Deputy Chief Economist. And we have Marisa Di Natale back. Welcome, Marisa. Good to have you back.
Thank you.
Yep. And you are head of global forecasting. Last time you were on a couple of weeks ago, 2 or 3 or 4 weeks ago, we were talking about forecasting. This go around, we're going to be talking about the state of the American household. Maybe better put, the state of what should I say? The financial health of American households. I don't know why that was so hard to say, but we're going to be talking about how well American households are doing. And it's apropos to have you on because you have a lot of expertise in understanding household balance sheets, and we'll get back to that in just a minute. This is a little weird, this podcast, right? It's Wednesday morning. Typically, we record this podcast Friday afternoon. We have a whole week of economic data to talk about, but because I'm going to be on a plane traveling, we decided to push this up a little bit. But it feels a little weird, doesn't it? To me, it does.
It does.
Yeah.
It does.
We don't have as much. Go ahead, Cris.
Yeah. So I'm just a preview. I'm going to break the rule in terms of the week indicators within the week. I'm going to look back 2 weeks. So.
Ryan, is he allowed to do that? I mean, he just unilaterally changed the rules.
Yeah, I guess we're gonna have to comply.
Just 3 days, not even Wednesday, right? So
no, that's fair. I was thinking of doing the same thing, but then I was thinking Ryan would give me all kinds of grief for doing that. So
he'll do that anyway. So.
Mine is from last week too.
Yeah. Oh, okay.
I already know what
it was fair game since it's a short week.
Okay. Fair enough. That sounds good. I think that's fair, given the situation that we're in. I did though send an email out just kind of outlining the conversation a little bit. I think we should focus on indicators that relate to the Delta variant and the impact on the economy. Is that fair? Is everyone on board with that, or is that consistent with your indicators?
Also, certainly, right? But we also want to talk about the household financial health, right? So a little bit of both, maybe?
Okay, a little bit of both. Okay, fair enough. I have a feeling Cris is
I know what Chris's indicator is.
Yeah. I just gave it away.
I think I know.
Playing at home.
Yeah, okay. All right, fair enough. Okay, well, why don't we begin with you, Cris? Oh, well, I should say, just for the fair listener, as you know, part one is a discussion of the indicators, and we each put forward our favorite indicator for, I guess now, last week and this week, and then we do turn to the topic at hand, and we are going to focus on the health of the American household, the financial health of the American household. Okay, so with that, Cris, let's start with you. I'm intrigued. What's your indicator?
So this is underhanded softball now. It's 37.7 billion.
Now, I think I know. Marisa, do you know? I think this is right.
I think so.
Right.
Okay. I'll let you go. Ladies first. Go ahead.
Well, is it growth in household credit over the last quarter?
That's right. The G19 series from the Federal Reserve. So that's total consumer credit, revolving plus non-revolving.
Oh, well, okay. Well, let me ask, let's just make this a little harder.
Okay.
Okay. But before I do that, give us some context. Is that what kind of number is that? 37?
That's strong. Certainly it's strong in normal times. Certainly it's a big jump, and certainly coming out of COVID, it's a big increase. Increases in, like I said, both non-revolving and revolving, almost a 50-50 split, right? About 18 billion on the revolving side and 20 billion on the almost 20 billion on the non-revolving side. So consumers are out there borrowing once again. They're charging on their credit cards. They're still borrowing for autos, student loans, right? Really across the board, you see credit growth, and that's supporting some of the spending we're seeing.
And revolving means basically cards, bank cards.
Basically bank cards. Yeah. Although now things are shifting as well. We can get into some of these trends as well. The millennial generation in particular is attracted by the buy now, pay later type of arrangements. Less interested in the credit card, perhaps, although that remains to be seen. So That revolving component, it seems as though that also captures some of these newer fintech type of loans as well.
Oh, got it.
And gas prices.
Gas
So
prices,
revolving, yeah.
Yep.
So when gas prices go up, you see revolving credit go up.
Yeah, good
for
point.
sure, for sure.
Yeah. And non-revolving is mostly auto debt and student loan debt, correct?
Yes, and it would also include the fixed term personal loan.
Right. Well, here, let me make this a little bit more complicated. What was the increase in total household debt in the quarter?
Oh, including mortgage?
Was that 30? Oh, wait a second. Was that 37.7 billion the monthly increase, or was that the quarterly increase?
That's a monthly,
Monthly. Oh, okay.
Yep.
There was a monthly increase.
May to June. Yeah.
May to June. Oh, really? So, okay. So what was the quarterly increase? So this is Q2 in the total household debt outstanding, which would also obviously include
Mortgage.
first mortgage debt. And Mercy, you should know this, I think, because this is based on the Equifax data.
Yeah, and it came out last week, but I don't know it off the
Came
top of
out
my head.
last week. Yeah. No, you don't know that data? Oh,
I'm gonna look
okay.
it up. I can look
I'm
it
gonna
up and
show
tell
you
you.
up. I'm going to show you up. It's about $100 billion increase in the quarter. And actually,
Right,
credit
94. Yeah.
was it, how much was it? 94?
94 billion. Yeah.
Yeah, about $100 billion.
That was the month. Sorry, that was the month of
Oh,
June.
was it the
Yeah.
month of June? Oh, okay. I thought it was the quarter. Okay, so the month of June. So,
Or sorry, July. It was July.
oh, geez.
Yeah.
I think we should start this
6%
podcast
over.
over.
The perfect podcast has ended.
It's like, all right, we sort of know the data. Okay, look it up. Okay, but it does show that household credit growth is picking up. It's accelerating. We're now seeing kind of mid-single digit year-over-year growth, and for a while there it was obviously declining. So big turnaround there. Okay, fair enough. Okay, Ryan, what's your statistic?
All right, so I got two. I have an economic one and a non-economic one, but we'll save the non-economic one because it's the perfect transition to the big topic.
All right.
All right,
Okay.
so I'll give you the economic one right now. And this is, you're going to screen that this isn't fair, but Mark asked for something that shows the Delta variant impact, and the number is 32.1%.
32.1%.
That's positive. No negatives. No.
Yeah, I know my
It's
signs.
an inside joke, by the way.
Yeah.
Not that inside if you listen.
Go back and listen
podcasts
to
ago.
the last podcast Marissa was on. Oh my goodness.
32%.
32.1%. It's a weekly number.
A
It's a
weekly number.
And you said it's related to the Delta variant,
Mhm.
or showing some impact of the Delta variant.
Yep.
Is
Can you give us another hint?
The only market to show an increase was Philadelphia.
Oh, so I don't know. That's
This is a metric that I've been tracking. It's kind of
Oh.
off the radar.
is it the stringency index?
It's not. It is not.
I don't know, Ryan. What is it?
So you went back into the office. When you go in the office, you swipe to get in. So there is a Castle Back to Work Index, and they track the across 10 markets the number of people are going in and out of the office, and this is down from 34.8% at the end of July. So since the beginning of August, we get this big surge in COVID cases. It's slowing and reducing the number of people that are going back to the office.
Oh, has it been steadily improving, and this is the first kind of step back in that?
Yeah, it was improving, and now since late July, it's been just coming down.
Oh, interesting. And Philly was the only metropolitan area out of what you said 10 that.
Yeah, they
actually-
tracked 10. In the last week, Philly was the only one that went up. They were down across the board.
Yeah, and there's hardly anyone going to work in Philly. I know that, at least into the office buildings. That's interesting. And I was in the office, our office, was it Monday? Yeah, on Monday. And I think that was the first day that people could go back if they wanted to go back. I think we call it a phase one reopening. And I can tell you, there were 3 people in the office other than me. 3 people. And they were, it's funny, I ran into 2 of them. They were brand new employees. I mean, literally brand new. And they were just kind of looking around, looked a little lost. I didn't know who they were. And they were of the 3 other, and Phil, the really good data guy, was in also. So it was, I think it was, Summer was also in, the office manager, but that was it. Okay, so are we going to come back to you then, Ryan, for the non-economic one in
Yeah.
a minute? Okay, all right, good. We'll do that. And then, okay, Marissa, what
Okay.
is your statistic?
I think this is easy.
Okay.
It is 96.7. It's an index value of a week ago.
Do you know, Ryan? And this also sheds some light on whether the Delta variant is having some impact on the economy. 96.
Right.
Oh, is this our back to normal index?
That's my guess.
Yes.
No.
But
For which state?
Yeah, I got to figure out the state.
Oh, no, now you're going down to the state level. Oh,
Florida?
Florida.
yeah,
Yeah.
it's
Oh, boy.
Florida's back to normal index. So, I mean, I think it's significant because Florida had risen up above 100% back in May and reached, so the index it's indexed to 100. We should tell people it was indexed. I mean, you guys have talked about it a lot. It's indexed to right before the pandemic in late February 2020 was 100. It combines a whole bunch of private data and big data and economic data to see how normal every state is. And Florida has been well above the national average almost the entire time, just given that it hasn't had the stringent lockdowns that a lot of other states had. But it got back above 100 in May. It was well above 100, about 102, 103 for most of June. And that has been falling since, Delta really emerged in mid to early July. And now it's 96.7. So it's still above the national average, but you definitely see it faltering. And Matt Collier, who's our colleague who puts the index together and covers it, writes about it on Economic View, was saying that of all the states where Delta has surged in the past month, this index value has fallen about a percentage point. And in the states that have reimposed lockdowns that are doing relatively better, the index is still rising and rose by about a percentage point. So you're really starting to see the impact of, I think, the virus itself having taking a toll on some of these states where there is a resurgence of cases, hospitalizations, and now deaths, even if the state isn't, necessarily implementing new lockdowns or restrictions to spread the flow of the virus.
Yeah, just for context, nationwide, and I think this is a really good indicator to follow because we construct it every day. We release it once a week on a Friday. It's at a state level, and it really is very sensitive to what's going on right now. Nationwide, we're stuck at 92%. So we steadily improved. It steadily improved in the spring, early summer, as vaccinations got rolled out, and then really since mid-June, really kind of early July, it's gone flatline nationwide, and that reflects declines in the index in states where vaccination rates are low and the economy is starting to struggle. That's being offset by continued improvement in some of the other states that are more vaccinated and infections are low, like New York continues to improve, but still kind of going sideways here. That's a good one. That BNI index, that back to normal index, we constructed it with CNN Business, and we put it on our Economic View site, but you can also find it on CNN Business as well. They have a pretty good visual there that helps you kind of look at that index over time by state. Okay, good. That's a good one. All right, I'm going to give you 2 numbers just to help you out a little bit, and they are related to providing some sense of the impact of the Delta variant on the economy. And the 2 numbers are 70 and 15. 70 and 15. And these are, related indicators. They're different indicators, but they're related. One of them came out this week on Monday. The other one came out last week on a Friday.
So the 70 is something with UMISH. Is that
The
present conditions?
That's the overall index.
Oh, the overall, yeah. So that was down
Universal-
11 points. That was an enormous drop.
Yeah, that is a big, and in fact, I think 70 is the lowest reading since the pandemic hit, even lower
Correct.
than back last March and April. What about the 15? It's
Is
related.
that That's our global business confidence survey.
Exactly. That's right. And
Because that was my backup statistic.
Oh, was that right? Okay. Yeah. We have our own business survey, weekly survey we've been doing since 2003. It's a diffusion index. So percent of positive, less percent of negative responses. And it improved again in the spring and early summer when vaccinations were getting rolled out, but has gone flatline now over the last really 6-8 weeks. Here's the interesting thing in last week's reading, though. One of the questions is a broad one around present conditions. So the survey respondents asked, how do you assess current business conditions broadly? And that, again, that's a diffusion index, percent of positive responses, things are improving, less percent of negative responses, things are getting worse. That turned negative last week for the first time since back in March. And that present conditions question is, I think, the most sensitive to what's going on in the economy real time. So that gives you a sense that I think the Delta variant is having an impact. It's really starting to I don't know. We got retail sales yesterday. They were very, very weak. That probably, there's a lot going on there, right, Ryan? That I don't know if you can.
Yeah,
see
it's nothing to do with Delta. Delta
Nothing
really,
at all?
no.
Okay.
You'll see it in
Restaurant-
the August data for retail sales, the Delta variant, the impact on restaurants.
Oh, I see. Right.
Yeah, the
Restaurant and
weakness in
bar was
August-
actually up.
Yeah, it was up in July.
What was
So
up in
that's-
July?
Yeah, that's pre-surge in COVID cases. The weakness in
was up?
August or July, that was the timing of Amazon's Prime Day, the drop in vehicles, that all weighed on retail sales.
So I'm sorry. What happened in July? What was up in July? In the July retail numbers, restaurant spending. Is that what-
Restaurant and bar
Restaurants was, yeah.
Oh, okay.
It was up 1.7%.
Oh, was it? Okay. All right. Very good. But what do you think? I mean, how big a deal is this? I guess if we're all assuming, and it feels like we're kind of all assuming the Delta variant is going to roll over here, that infections and hospitalizations are going to start to come down in the next few weeks, kind of sort of what happened in the United Kingdom, which seems to be leading us a bit in terms of the waves here. But if that doesn't happen and this continues to, the infections and hospitalizations continue to increase, how worried should we be? Or let me put it this way, when should we get worried? What do we have to see before it starts impacting the economy to the degree that our optimism about the economy starts to fade a little bit? Or has it already started to fade?
I think it's all about the schools, right? If we,
I was about to say that.
if the infections do get, if the hospitalizations, actually, that's the key factor I would watch. If those rise to a level that threatens the hospital system, then you could see more imposition of, stay-at-home requirements. And if the schools have to go online again, then I think that certainly is going to impact the outlook, certainly over the next quarter at least.
Yeah. So if schools don't reopen for in-person
Right.
learning, that would be a clear tell that this thing is going to do some real damage to the economy. Yeah.
I think so. I don't know, Marisa,
What about
Ryan.
you? It just feels like the data is the data coming, they ebb and they flow. So I don't want to read too much into the ebbs and the flows, but it feels like it's ebbing a little bit here. The numbers, all these different statistics coming together, and it's the big statistics like retail sales, and it's the minor statistics like the home builders sentiment index. They all are coming in now, surprising to the downside a bit. It feels like is that
Yeah,
just
you don't want to read too much into it because things are still really, really strong. So control retail sales are still 18% above their pre-pandemic level. So things are coming off the boil, but I mean, the economy is booming, earlier this year. So
control retail sales being
control retail sales. Yep.
what's that?
So that's total retail sales, excluding autos, restaurants, building materials, and gasoline. And that's what feeds into the BEA's estimate of real consumer spending.
Yeah.
And I mean, a lot of that was that shift from service spending to goods because, during lockdowns and the pandemic, people weren't going out to restaurants. They weren't going out to, movie theaters and things like that. So they shifted their spending towards goods, which is mostly what retail sales captures.
Okay. All right.
And you don't really see, correct me if I'm wrong, Ryan, but we're not really seeing huge movements or slowdowns in like the Google mobility
Correct.
or table or anything like that, right? Which is
even like weekly gasoline demand is still holding up.
I don't know, but like, I mean, the Bank of America, they track card spending. Do you see their release? It showed spending on airline tickets really starting to fade here in the last couple of weeks. Spending on, I believe, on hotels fading. Travel seems to be being affected.
Yeah, the number of people going through TSA checkpoints is declining, but there could be some seasonality there. We're coming towards the end of the summer, so it's really hard to read through the signal versus the noise.
Okay, I mean, I think you're right. I mean, we haven't changed our forecast. It's still, a very positive, upbeat forecast, and I do think that's why I love the GDP tracker that we have that takes all the disparate pieces of information and through statistical techniques translates that into an estimate of GDP growth in the current quarter, which is Q3. And right now, I think it's still at 6.5% annualized, correct? And that's correct. I read this morning, housing starts came out today, and they were okay, a little on the soft side, but they didn't change that 6.5%, which would be,
no,
that's pretty good. Yeah. Okay.
Yeah, I mean, part of it is that, completions is still pretty solid, and permits, which lead housing starts, they rose. So, I think we're in this little bit of a blip. So things should start to pick back up for housing.
No, this is just a temporary.
Yep.
Okay.
And housing starts are very volatile. They're unreliable. They're subject to enormous revisions. So we really don't want to read too much into month-to-month fluctuations in starts.
And I guess, Chris, the statistic you've been following pretty regularly here, initial claims for unemployment insurance.
Yep.
They're elevated, but they continue to move in the right direction. Is that right? There's no sign in that data that Delta's doing any damage certainly not to the labor market.
Not yet. The last read was for early August, I think August 7th, right? So at that point, it was 375,000 for the week, and that was trending down. So still elevated by historical standards, but showing continued improvement.
Yeah. Okay. So
we get claims tomorrow for the payroll reference week, and people are going to read too much into it, but they're going to drop a lot. Just because of seasonal adjustment issues. And so people are going to be like, oh, the Delta variant's not affecting the labor market. You really can't trust claims right now, not until, later, in another week or two.
Payroll, you notice Ryan, he's getting to be very jargon-esque, control retail sales, payroll reference week. Like keep up with me, guys. Well, come on. What is the payroll reference week?
Well, I'll let Marisa. I mean, Marisa, she used to do the report, so she can elaborate much more than I can. She's like the expert.
I can interpret Ryan's jargon.
Yeah.
He's my interpreter.
Okay. He's your whisperer. Marisa is the sweet whisperer.
Okay. So the payroll reference week is when the BLS surveys employers to find out what the count of, employment gains or whatever are each month. They're asking about a specific pay period during the month. So they're asking about the pay period that includes the 15th of the month for the payroll survey, the 12th of the month for the household survey, or do I have that the other way around?
I think she's got that wrong. And my goodness gracious.
You had a chance to redeem yourself.
Oh my gosh. That's like, Oh,
Well, one is the 12th, one is the 15th.
Right.
you got it.
Do I have it backwards?
Yeah.
Yeah, the 12th for the, okay, so it's the 12th for the,
And you used to put
period,
this
the-
data together for the BLS? Oh my God.
It's
Come
been a
on,
while.
it's been 18 years. Thank you.
I don't think Marissa appreciates my humor.
I do.
You
I do.
It's early for her. Yeah.
That's
Yeah.
right. Oh, I forgot about that. You're sitting in California. It's like really early there for you. Yeah. Well, you know, and you don't even have Wawa coffee in California. So.
No, but I have a nice Nespresso, so
Okay.
I'm good.
Okay.
Anyway, so they're asking about this specific pay period during the month, and that's what employers are answering the question about. You know, how many people are on your payroll during this pay period of the month. So the jobless claims figure that comes out during that week gives us a preview into what the payroll number might be.
Okay. And so Ryan, you're saying it's actually going to be a positive surprise. And
Yeah, it's going to fall a lot more than I think people anticipate.
okay. Interesting. Okay.
What's your guess?
Well, I don't guess. There's no guess.
Oh, jeez. You just said it's
No,
unreliable. It's
I mean,
unpredictable.
Mark's criticizing me for jargon. I got 350, but I wouldn't be surprised if it comes in lower than 350. 350,000.
Oh, that's a substantial
big drop.
Yeah. Yeah.
Okay. All right. Okay. Very good. And the indicator I've been watching also this suggests no damage from Delta, at least not globally. And that's copper prices. Although I haven't looked in the last.
They dropped a lot yesterday.
It's weak.
They
Oh,
fell
did
almost
they?
3%. Yeah.
Oh, okay. So what did it fall to? Do you know?
415, I think was.
Oh, okay. It's still
Yeah.
over $4. So.
Still over 4, but approaching.
Yeah. Copper prices, anything over $4 a pound is consistent with a pretty strong economy globally. It's Dr. Copper. But it was at 435. So that came down quite a bit. That is interesting. So we'll have to watch that. Oh, that came down with the market. All markets were down yesterday, though. Equity markets were down. And that gets to bond yields. They're back down to 1.2. 10-year treasury yields are back down to 1.25, I think.
Mm-hmm.
Oh, my goodness. And is that, I guess, Delta is having some impact here on.
Yeah, a little bit. Yeah.
Yeah, a little bit. Right. And in all markets, I think. I haven't looked today what's the market doing today, but I'll be curious to see. But anyway, okay. So the conclusion, bottom line, don't worry, Delta, it's not helping. Certainly no upside here, but the downside feels limited. And unless schools en masse decide to stay online, we should be okay here. We should kind of navigate through, and our optimistic prospect outlook for the economy should hold forth. Yeah, that's kind of the general consensus view here. Anybody disagree with
Yeah, no, I'd agree. I think we're banking on things rolling over. Missouri is a good example where things got really bad. Now they seem to be improving. So it seems as though this Delta variant will burn itself out, hopefully.
Okay. All right. Well, that anything else on the indicators you want to talk about? I mean, I think we covered a lot of ground there.
You want my number for the perfect segue?
Yeah, the perfect segue. Let's hear it.
So the perfect podcast we know is it's over. All right, it's Wednesday, so it's Wacky Wednesday. So here's the number. It is a perfect measure of consumer behavior. 32,340.
This is non-economic, though, right?
This is non-economic. Well, I guess there's a little economics to it.
Is there any probability we would know this number?
No. Well, no.
Okay. What was it again? 32,340?
Yeah, I mean, it's a Guinness World Record. You might be up there if they had it for Wawa coffee. So it's a personal consumption of something.
And is it global or US?
There's one person since 1972.
Person consumed 32,340 of these things.
Yep,
whatever.
Since 1972. Two a day.
Two a day. And this is somehow relates back to the health of the American consumer.
Maybe the health of an individual consumer. Yeah, but
okay, all right.
It's getting really micro here.
We are getting
very
very
micro.
Yes.
One person world record. Anybody want to take a crack at that before we say we give?
Hot dogs.
Close.
Oh, wow.
Yeah, it's a food item.
Hoagies. Yeah.
Chewing gum,
Chewing gum.
breath mints.
Big Macs.
Breath
Big
mints.
Macs.
Big Macs.
She's projecting now. She's projecting. Yeah, breath mints.
No, one individual consumed 32,340,000 Big Macs since 1972. 2 a day.
Is that person still alive?
Yeah,
Still adding to the record.
they're still adding to it.
What
And
does this have to
and-
do with anything, Ryan? I mean,
consumer
come on.
spending. Consumer
Okay.
spending. Can you imagine the amount of money they spent on Big Macs? Hence, segue into the American.
Oh man, that is
Ooh,
a
wow.
huge leap. I don't know. What
Bit of
that
a reach, Ryan.
That is a reach.
You guys aren't impressed by that? 32,000 Big Macs?
32,000
Impressed or
I
a bit
slightly
disgusted?
disgusted.
Since when, Ryan? Did you say 1970?
1972.
1972. Wow, I didn't even know they had Big Macs that far back. 72. Interesting.
Mhm.
I guess, sort of. Okay, the big topic.
When you said the health of the American consumer, Ryan took
Yeah.
that literally.
You took that literally. You took that literally. Yeah. Okay, so that is the issue here, and when I think about the health of the consumer, I think broadly three things. One, jobs and income. Are they employed and are they getting pay increases? Second, debt leverage. Obviously, big problem prior to the financial crisis. Not so much right now, but leverage. And what do they own? Assets, house prices, and stock values, that kind of thing. And if you kind of look at the consumer, the American consumer, from that perspective broadly, and I'm generalizing. It's a broad brush. There's obviously lots of distinctions we can and should make across the population, but broadly it feels like the American consumer is in pretty good shape, right? I mean, clearly the pandemic has been a problem, and we're still recovering from the pandemic. The consumer, unemployment's 5.4%. It was 3.5% before the pandemic, but we're creating lots of jobs. Unemployment's coming in, and it feels like we're going to head back to full employment pretty quickly. Leverage and wage growth has been held up admirably well in the pandemic. People have been able to save. There's a lot of excess saving. Leverage is low. Here's a statistic for you. I was looking at before in preparation for this. The financial obligations ratio, that's the percent of income, disposable after-tax income, that consumers, households are devoting to meeting their financial obligations, which includes not only their debt payments, but also lease and rental payments, is 12.9% as of Q1 2021. That's a record low. We've got data back to 1980. The average is close to 16%. So leverage seems low. Asset prices are, they've gone skyward, right? I mean, housing values and stock prices and bond prices and crypto prices and anything you own, I think is worth a lot more today than it was, a year ago, 2 years ago, 3 years ago, 5 years ago. So am I wrong? But, broadly speaking, the state of the American consumer is good, right? I mean, anyone disagree with that or take umbrage with that?
So in aggregate, under that kind of representative agent type of model, yeah, sure.
Yeah.
Absolutely.
Yeah. Okay.
But once you peel it back, right, that's when you see the distinction, certainly. by
Okay, go ahead and
demographic.
peel it back. I mean, how do you want to peel that back?
You can peel it back in any number of ways. I guess
Right.
one way would just be by income or education, right? So certainly folks who are more educated have been able to fare through better during the pandemic than folks with less education, just in terms of their ability to work remotely or hang on to jobs, right? So while savings rates are up, and they're up in aggregate, and they actually are up across the board, they certainly are much higher for folks in the upper income distribution, more highly educated, than at the bottom part of the distribution.
Right. So you're saying the obvious distinction
Yeah.
underneath is across income and wealth distribution, that there's been this ongoing skewing of the distribution. Low income households, low moderate income households have been left behind over the last, well, 35 years, something like that.
Sure. And the asset gains that you mentioned during the pandemic, whether it's housing or financial, right, those have accrued to the upper part of the distribution by a significant degree, right? Folks at the bottom don't hold a lot of financial assets. Many of them don't own homes, so they really haven't participated in those gains.
Right. Well, one fortunate thing in the pandemic is all the fiscal support that's been provided, right? Because that really helped low and moderate income households in particular navigate through the pandemic. Not gracefully, that's definitely the wrong word, but reasonably gracefully, right? I mean, the stimulus checks, the unemployment insurance, the food assistance, the rental assistance, that kind of thing. Would you concur with that?
Yeah. And like I said, the savings actually are higher. If you look at checking account balances by income, they are larger today or higher today, even for folks in the bottom 10 percentile than they were prior to the pandemic. So I attribute that certainly to a lot of pandemic stimulus support, as well as lack of spending opportunities, right, during the pandemic. So from that, if you just looked at that metric, sure, they're better off, but proportionally or relative to the upper end of the distribution, right, their gains are small.
Yeah, the other thing I've noticed is the labor market is tightened up, but it's really tightened up for lower skilled workers, and wage growth for folks in the bottom part of the wage distribution. Part of that's increases in minimum wage, but the very tight labor market for the bottom part of the wage distribution. That wage growth there has been actually quite strong, and that's helped too, I think. Marisa, Ryan, any other way you would broadly characterize the American consumer? So I talked about it in aggregate. Cris talked about it across the income and wealth distribution. Is there any other way we should be looking at it that provides some insight into the health of the American consumer, broadly speaking? No.
I mean, with any sort of income cuts or wealth cuts, certainly looking at it by race, for example, the vast majority of wealth and asset gains have gone to white households, not to Hispanic or Black households. Same thing with the income cuts. I think another thing, you had mentioned that the financial obligations ratio is at its lowest level ever, I think you said.
Yeah.
And a lot of that, what Cris just said, there's been not as much to spend on until recently. And then we've had a lot of fiscal support. I was just looking at the data on the child tax credit payments that have started to go out. And those are quite large and going to a lot of households. And you can see in that data, this is from the Census Bureau Pulse survey that they've been doing since the start of the pandemic, that people are really using that. 40% of people said that they're using it to pay down debt. And then another third of people are using it to save, and only less than 30% are actually spending it. So it just goes to this notion that there's a lot of excess saving and debt is coming down because people have been able to use some of this money to pay down debt as well.
Oh, I didn't know that. I missed that. So in the most recent Census Bureau's Household Pulse survey, which I recommend to everybody, that's a pretty cool survey that they've been doing more or less regularly since early on in the pandemic. In the most recent survey, they had questions around the child tax credit. Oh, and you can see that the bulk of that is being used to pay down debt and to save, not to spend.
Yeah, I mean, 40% of it is going to pay down debt. So this is data that goes, I think the latest iteration that they did goes through early August. So the questions were as of a couple weeks ago. And it's a wonderful data set because they ask all kinds of health questions about how COVID has affected people's lives in terms of not only health, but how they're working, how their children are going to school or not, if they're doing remote learning. And you can glean a lot of really interesting things, I think, from that data set. But yeah, one of the sets of questions is about all of the fiscal stimulus. So they ask about how are you using, if you're using extended unemployment insurance benefits, what are you doing with that? How much are you using it? what about just the stimulus checks, and now the child tax credit is part of the questionnaire as well. And
oh, go ahead. Sorry.
And you can clearly see that paying down debt and saving is, it's turned from those initial payments that went out, the first tranche of stimulus, people spent it, right? Which makes a lot of sense. But as you kept going, the spending kind of fell a bit more, and it went more toward paying down debt and saving.
Yeah.
And that's true across all income buckets too, which is very interesting. I mean, we know low income households are more likely to spend than save. And that was certainly true early on in the pandemic, but even now those lower income households are using it to save and pay down debt as well.
Yeah, and just to provide context, the child tax credit was expanded as part of the American Rescue Plan. That was the legislation support package passed in March. And that's in current law, that is from July to December, and then it will expire in January 2022, unless with this new legislation that's being debated in Congress, there's an extension of that child tax credit through 2025. And that's one of the reasons for this is that it's actually quite substantive. It's a pretty big, expensive line item, so it can be very costly. But it is clearly helping out low income households at least save more and pay down debt and help them with their bills. That's good to hear. That leads to a critical question with regard to our outlook for the economy, our optimistic outlook for the economy, and that is how much of this excess saving will be spent and over what period of time. So just to make that clear, what I mean by that, people's saving rates have increased dramatically during the pandemic. Part of that was I'm sheltering in place. I can't go to a restaurant. I can't travel. I can't do stuff. I might spend a little bit more on a heater for my back deck, or I'm talking me now, or a power washer. But there's only so many power washers one can buy. Therefore, you save more. And then it's also the government support, the stimulus checks and other support. Some of that has gone to, a lot of that's gone to low-income households who have spent it because they needed it to navigate through because they lost their job. But some of that went to even some higher middle-income households who have been saving it. And now, as you point out, even some of the child tax credit that's going to low middle-income households is going to savings and paying down debt, which is the same thing. So saving rates have been very elevated during the pandemic. So excess savings represents the difference in the actual saving rate and the saving rate that was evident prior to the pandemic. If there had been no pandemic, that's the kind of saving rate one would have expected. And if you totaled up all of the dollars saved in excess, this excess saving, by our calculation, it's almost $2.5 trillion. $2.5 trillion. That's over 10% of GDP. That is a lot of cash sitting out there in people's deposit accounts, and one other reason why other asset prices are rising. And the question is, how much of that excess saving is going to be spent and over what period of time? And I'm just curious. So, what do you think? Is that excess? If all that excess saving got spent, quickly over the next 12, 18 months, that would be, obviously a ton of growth, and the economy would probably overheat. So that's not what we're expecting. So I'm just really curious how people are thinking about this, and whether how much of that excess saving will be spent. I mean, do you have a view, Ryan, on that?
Well, our baseline is a third, correct?
A third between now and the end of 2022, right?
Correct.
A third
Which
of
I
that
think,
2.5 trillion.
I think that seems reasonable, but I think the risk is that it's spent slower and less than what we're anticipating, given the distribution of the excess savings really favors high income, high wealth households. So they have a much lower marginal propensity to consume. And I think they might treat that more as wealth than, extra cash. So I think that I think our forecast is reasonable, but I wouldn't be surprised if it comes out slower.
Right. Cris, I know you put together a nice deck with a lot of slides, and I saw one on the excess saving. I think you actually went and calculated the increase in the amount of cash sitting in people's deposit accounts, right? based by where they were in the income or wealth distribution.
That's right. This is data from the Fed. They produce distributional account information now. They actually break out all different asset types, right? So I just picked the checkable deposits just as the most liquid form of savings. And this goes back to my earlier point about there's a lot of cash sitting in these checking accounts really across the income distribution. But as Ryan said, it's really skewed towards that higher income household. So I agree with Ryan. I think that the risk is actually to the downside in terms of less of a burn or less of a cash coming into the economy over the next 12, 18 months.
And that would be consistent with what happens after post-World War eras, where you had a lot of excess savings during them. And then when you come out of it, it really didn't get released very, very quickly. So, it's a small sample size, but, that might be what we see going forward.
Yeah, there was a really great piece in Barron's going back to after World War II, and they had one quote from an economist, in that period saying, watch out, there's a lot of excess saving. I think he even used the term excess saving, I think. If he didn't, that's what he was implying, because there was a lot of pent-up demand. People couldn't spend during the war, right? Because we were all producing military equipment. We weren't producing homes or anything else. So his argument was, well, people are going to come home from the war. There's going to be this massive increase in spending, and we're going to have this huge spike in inflation. We're going to have a real problem with inflation. It felt just like the debate we're having literally, the debate we're having today. And of course, that did not happen. People did not go out and spend. Spending was strong post World War II, but it was not booming, and certainly not booming to the point that it led to this runaway inflation that the economists at that point in time were worried about. So I think that is a pretty good analog today. Marisa, any insight here on wealth, on excess saving that we missed?
Well, I just, what you just said kind of led me sort of to think about another question, which was all the stimulus that we've had over the past year. And, I remember there was some debate back when that was being proposed that, you're pumping all of this cash into the economy and giving all of this cash to households. And could that eventually spark inflation? And I don't think there's much evidence of that too. It's been so gradual. And a lot of the spending is still to come and will trickle out, over the course of, particularly like the infrastructure stuff where it has to be dispersed to states, and states need projects, and that will happen over a longer period of time. I mean, it's an incredible amount of money that's going into the economy, but it seems to be kind of being dispersed, at least gradually, over the course of years, and we're not seeing any huge spikes, I think, that we can blame on that in inflation either. I don't know if you agree with that.
Yeah, I do. I think that's right. I mean, I do think there was, one other concern expressed about all that support, fiscal support, or stimulus, as you labeled it, was that, it's kind of a waste of money, because you're not stimulating the economy if people are going to save it. But I would take umbrage with that. I mean, I think, it's very important to help out these low middle income households that, were having a great deal of difficulty, and still are having a great deal of difficulty, kind of navigating the pandemic, through no fault of their own. And they had no savings. And so, helping them out here to kind of navigate through was obviously helping them out, but I think ultimately helped out the economy. So I don't think that argument was a very good one either, but that was one you also heard.
I'm actually hopeful that the savings stick, right? Before the pandemic, we were very concerned about financial fragility, as you recall.
Exactly.
Right? So many homes can't afford a $400 emergency expense.
Yeah. The other thing, sorry, go ahead, Chris.
Just to say, if these savings help, or these stimulus funds help them to build up some cash buffer, that points to our long-term resiliency.
The other thing I really worried about, if you go back a year ago when things were really tough, unemployment very high, and you remember the riots in the streets that we were experiencing last summer, it felt like the whole social fabric of the country could come undone. And I get it. I mean, if you're a household, you're out of work, no prospect for going back to work, you're stuck at home, your internet connectivity is poor, you got kids there that are struggling to adjust to the situation that they're in. Um, incredible hardship. If we hadn't provided that support, what would have happened? Would the fabric of the nation actually rip apart? But it didn't. It kind of held together, and I think one could argue that that's because of all of this support. It really did help these households navigate through this period reasonably well. So I think that was important from that perspective also. Another issue, concern about the health, again, about the health of the American consumer is sticking to government support, is that, the federal government has also provided support to households with debts. So various moratoriums on rental eviction, moratoriums on foreclosure, for government-backed loans from Fannie Mae, Freddie Mac, FHA, VA, USDA. Also forbearance on mortgage payments for government-backed loans. So, if your income was disrupted by the pandemic, you're having trouble making your mortgage payment on a Fannie Mae loan, you could get forbearance. And so a lot of people have gotten, and forbearance means I don't make those mortgage payments. I think it was up to 18 months in total. Student loan borrowers also have forbearance. And correct me if I'm wrong, Chris, I think that now extends into January, doesn't it? January 2022.
That's right.
Yeah. So, but all those supports to consumers on the debt side of their balance sheet, on the leverage side of their balance sheet, are going to expire. It's just it feels like it's now probably by early next year, this is all going to go away. The rental eviction moratorium, which is extended through October, if it's not changed by the courts, will expire. The forbearance is starting to wind down. One of the concerns was that as that support faded away, this so-called forbearance cliff would be a problem, that households would struggle with that, and that would hurt their ability to spend on other things. So if I don't have to make a mortgage payment, I can spend on other things. But now that I have to make a mortgage payment, that will create problems. And it will also lead to other credit issues, people not making mortgage payments or student loan payments or card payments, whatever it is. How worried should we be about that at this point? Any insight there? Chris, I'll turn to you and then to Marisa. How are you feeling about that so-called forbearance cliff at this point in time?
Yeah, not particularly worried, certainly when it comes to mortgage, just in terms of everything that has gone on in addition to the forbearance, particularly the rise in home prices. So the demand is strong, incomes are growing, jobs are plentiful. So I believe that homeowners will be able to, most homeowners will be able to resume their payments. I don't see much of a problem there. For those that can't replace the income or continue to struggle, they, from the bank perspective or the lender perspective, at least they have the option to sell their homes, right? For many of them, they have positive equity, so I don't expect to see a wave of foreclosures, for example, at the end of the forbearance period here. So for mortgage, I'm not particularly lending standards have continued to remain very, very tight even prior to the pandemic. So I don't see a foreclosure cliff coming anytime soon there. So from that perspective, I'm feeling pretty comfortable.
What about student loans? Should we be worried about that?
So for student loans, I think what we'll see the problems that we had before the pandemic, before the forbearance went into effect, will be revealed once again. There, it's a little bit different situation because the defaults really do or are highly correlated with the performance of the borrower as a student, right? So we see that most defaults or most significant defaults come from people who took out some student debt but didn't actually complete the degree or took out or studied in an area where the degree has very limited value. So as the forbearance expires, I think the people who have well-paying jobs, college educated, they do have student debt. I do see them as being able to restart their payments. but it's that group once again that has perhaps limited amount of student debt, but doesn't have the income generation opportunity to service the debt. So I think that will be a problem, but I don't see this as a problem that's any worse than what we had prior to the pandemic.
Yeah.
Again, because the labor market is relatively strong.
Marissa, anything to add to that? Any or different perspectives? You disagree with anything Chris said?
Back on the mortgage forbearance. So it's relatively small. So the number of people that are behind on mortgage payments is about 7 million people, and that's a little under 8% of all households that have a mortgage.
So that's the Equifax data that you're referring to?
No, this is actually also from the CPS, the Pulse survey.
Oh, the
data.
Pulse.
Oh, the Pulse
Yeah.
survey. The Pulse survey.
Yeah. Yeah. So this is very current as of a couple of weeks ago. So there's 7 million people that are behind on their mortgage payment, and almost like 40% of them, a little less than half of them, are unemployed currently. So, I mean, I think you can clearly see how helpful some of these programs have been just to get us through the past year and a half on this stuff. But I think that's still a relatively small percentage of all homeowners and mortgage owners. And I think, like Chris said, just given the increase in asset values over the past couple of years, I think that becomes less of a worry when this does start to roll off.
Marissa, I don't think I'd be using that data. I'm not sure. 7 million, that's a lot. I mean, there's 49 million people with mortgages. So 7% would be a very high delinquency rate.
Okay, well, it's people that live in an owner occupied home where there's a mortgage on the home. So I think that it could be higher because you have multiple people in a household.
Oh, that's what's going on.
Yeah.
That's what
they're asking about. Yeah. So they're asking individuals, and they're asking about, does the household have a mortgage? Okay.
Yeah. I think I would use our data or the Equifax data which shows very low delinquency, but some of it because it's forbearance, but to your point, but I'm not sure I'd use that Pulse survey. Just a little wary of it in that context in terms of the numbers.
Yeah, I wanted to look at it just because I wanted to cross it with the different kinds of stimulus and forbearance and fiscal help that's been offered to see how those people are or not using it.
Well, here's another statistic. This is from the Mortgage Bankers Association. There's 1.6 million people that are receiving some form of mortgage forbearance at this point in time. So and that's declining very quickly. They release that data every single week. It's falling pretty quickly. I think the delinquency rate or the forbearance rate is about 3.5%, but that's coming in pretty quickly now at that point. So that makes me more
that's
consistent with what you're saying, that we're coming to the same place using different data, but I feel less worried. I think it is important to point out though that delinquency rates, loss rates, foreclosure rates are going to rise, right? Because they are very, very low because of all this forbearance. And as that goes away, they're going to rise simply just to normalize to kind of levels that prevailed prior to the pandemic. So
they're already rising. I mean, if you look at the Equifax data across all different kinds of household debt, they're rising, but from very, like you said, very, very low levels. But they're starting to tick up as credit is expanding and people are spending again.
Yeah. Okay. So we've talked about income and savings, all feels pretty good. Okay. Obviously higher income households, a lot more excess savings than lower income households, but across the board feels like we're moving in the right direction. We've talked about leverage and debt, talked a little bit about the forbearance cliff. There again, feels like we're moving in the right direction. Everything feels pretty good. We've got a ways to go before we're back to normal, but we're headed in that direction. Let's talk about the asset side of the household balance sheet. And of course, assets are largely owned by, a small part of the population, right? I mean, home ownership rates are 65%. So that means, 35% of the population are renters. But if you look at stock holdings, only 50% of the population own any stock whatsoever. And the bulk of that is in the top, 10% of the wealth distribution. Deposits and other savings accounts and fixed income assets, again, pretty skewed. But that feels really, I mean, what's not to like about what's going on with asset prices, right? I mean, now I've got a couple of worries there, but before I express my worries, do you guys have any concerns about that? What's bugging you about the asset side of the balance sheet, or is there nothing to worry about on the asset side?
Well, one thing I would
Right.
say is just as we're talking about excess saving with all these high income households, it's very likely they'll invest some of that even further, right? So especially high income households with that cash, they're not going to have that sitting in a savings account. They're likely to invest it either back into equities or maybe into real estate. So, I mean, I think you're going to have more growth.
I got a good story there.
on the
My
asset
mother-in-law, every time a CD rolls over, will call and say, "What do I do with that money?"
side. So
Which
does
I
my
do.
mom.
I'm curious. Well, this is what I tell her. I'm curious what you tell your mom. I say, I don't know. So
That's a good answer.
I said, because she's in her 90s, right? I mean, do you really want to invest in equities or even fixed income or, so I said, well, mom, maybe just keep it in cash, and she kind of says, she wanted to know about gold. And I said, I'm not so sure. And she goes, what's this thing called Bitcoin? So I said,
Oh, no.
I know. I said, no, why don't we just keep it in cash? And she goes, well, okay, what is it you do for a living again? So, okay, how do you answer your mom when she asks that question?
I tell her that she's paying a financial advisor to answer these questions and go ask him. No, I mean, I just it's just how much do you want liquid versus basically I told her just let it roll over and give him the money and have him invest it.
Yeah.
I don't know what it is, but anytime anyone asks me what I do, I said, I'm an economist. The first question is, what's going to happen with the stock market?
Yeah, me too.
I was like, I am the wrong person to ask that question.
Okay, Ryan, what's going to happen with the stock market, man? That's what everyone on this podcast wants to know. What you think is going to happen with the equity market?
I think it's going to keep going up until
it goes down.
Exactly. I mean, I think the fourth quarter of this year is going to be rocky because you're going to have the Fed tapering, you're going to have the debt ceiling battle. But again, that's like, the stock market, corrections are normal. They happen every 1 to 2 years on average since the 1970s. But over time, it's going to continue to climb.
Okay, I got two worries. Well, I guess there were three. We just tackled one, and that is, well, what do I do with my savings? Where do I invest? That's one worry. Second worry is, what happened to the wealth effect? And is there let me throw this out. This might be an anathema, but could there be the wealth effect's been flipped on its head? That, the wealth effect is if I'm wealthier, if the value of what I own increases, then I'm going to save less and spend more. Not, it may not be a lot more, but I'm going to spend a little bit more, right? Because I'm wealthier. I'm prepared for retirement, my child's college education. I don't need to save as much. And historically, that is kind of sort of what happens, right? Stock prices go up, people's saving rates go down. House prices go up, savings rates go down, people spend more. That's not what we're observing now. In fact, could it be flipped on its head because we were seeing boomers, people in their, now in their, late 50s, in their 60s, early 70s, saying, hey, I'm worth a lot more than I was. Do I really need to work anymore, particularly given this mess called the pandemic? And we have seen participation rates for people 55 years and older really come down a lot, right? And they're not coming back, at least not so far. And that may be, a pretty big hole to the labor market. So it's actually hurting growth, not helping growth. Am I onto something here? What do you guys think? Does that sound right to you? It's kind of a negative wealth effect.
Isn't there a positive spin to it that, particularly on the housing side, that people aren't using their house as an ATM anymore, which caused a lot of problems, during the bubble, the housing bubble in the early 2000s. So it wouldn't be, you could make the argument that it's actually a good thing that people are saving the wealth in their house instead of tapping it like an ATM.
Okay, that's
machine.
consistent with what I just said, though. It's
Yeah, I think that's good though.
negative. I'm not. Yeah. Okay. So you say, okay, so it's actually a negative wealth effect. It's not a positive wealth effect. That it's reducing higher wealth traditionally meant more spending, more growth. And now we're saying higher wealth means less spending, less growth. That's different. That's a big change. Is it?
It sounds like you're saying it's a temporary thing.
Well, I don't know how temporary.
Around the pandemic.
Yeah. Well, I mean, it's temporary, sort of. What's temporary though? I mean, it could be like the wealth effect could be flipped on its head for the next 2, 3, 5 years, right? I mean, depending.
I also wonder if households really believe the wealth that the wealth gains that they have are real, right? They have gains on paper, but I think increasingly people are worried about and expect some type of house price correction or adjustment or financial markets. They would expect to see some decline there. So perhaps they're not willing to spend these gains that look great on paper.
Yeah.
Right,
I mean, yeah. I'm sure and that goes to my third concern, and that is, well, how resilient
durable,
are these asset prices? How durable are these asset prices? I mean,
right.
It feels like they're disconnected increasingly from underlying fundamentals, stock prices to corporate earnings, housing values to rents, crypto to nothing, so. Yeah,
Well, that's where crypto's headed.
To nothing.
To nothing, but.
Yeah.
$2 trillion market though. It's crazy.
There he goes.
I know,
In his pitch.
Yeah. So, but what do you guys think? Am I onto something, do you think, in terms of maybe we should explore this in more detail? I mean, because that would be different than anything we've experienced historically.
But to Marissa's point, it could be, maybe the wealth effect, the lags are much longer. Because wasn't the stock market wealth effect, over 1 to 2 years, they spent that money? Maybe it's, a little bit longer than pre-pandemic.
Right.
And it was interrupted by any spending that could have been done was interrupted by a pandemic. So
I also wonder if there's a permanent shift in consumers' preferences, right? The pandemic influence conspicuous consumption and what people want to spend on, the more sensitivity to climate, right? So they're not going to buy a flashy car perhaps. And so...
Well, Chris, that's definitely not your household. I mean, yeah, come on. Just to take a look at your house. Well, you're Ryan, doesn't he spend like, they're out of control over there in the Drury's house.
Yeah, I drove by the office the other day. There was a Tesla in the parking lot. I think
who was that?
I know it's not yours. First thought was Chris.
Yeah. Well, no, actually, Marissa, she's out of control over there. She's in, Newport Beach, all those shishi restaurants and no.
I am actually thinking of buying a fully electric vehicle next year.
But you're in California, that's required.
That's standard.
Right?
Yeah.
That's standard. Right. Exactly. All right. Well, I think we covered a lot of ground. So bottom line, we're feeling pretty good about things. Obviously, again, a lot of pressure on lower income households, minority households in particular. But and I don't, it's not fair to say abstracting from that issue because that is a big issue. In aggregate, in total, the health of the American consumer is good and should support the economy going forward for the foreseeable future. Right? Any disagreement with that? We're all on the same page. Yep.
I do have some concern about the eviction moratoriums. I think if there's one piece of all of this that concerns me, it's that.
Yeah, it's a good point. I forgot to bring that up as part of the forbearance cliff that I was mentioning, the rental eviction moratorium, because the Centers for Disease Control extended the national moratorium through early October, but it's challenged in the courts, because it may not be constitutional for the CDC to do that. So it may expire earlier. And by our estimates, there are 6.5, 7 million renters out there. And that is a lot of renters. That there's, probably 48 million renters out there. So that's a lot of renters that, are behind on their rent and at risk of being evicted. So yeah, I agree with you. That could be an issue. Yeah. All
Do you
right.
think the funds are going to get allocated more quickly? Right, Congress had set aside.
Yeah. Well, just to bring everyone up to speed on that one very quickly, because I know we're running out of time here, is Congress and the administration, actually under the Trump administration, Congress, they passed a rental assistance of $25 billion. That was the December legislation. And then the March ARP, American Rescue Plan, they passed another over $20 billion. And so if you add it all up, it's 46 billion in rental assistance. And they're having a hard time getting that money out because it's being administered by state and local governments. And so the Treasury Department is cutting checks, but then the checks are kind of sitting there. And there's a great piece I read yesterday about New York's rental assistance program dead in the water. They haven't been able to get any money out because it's just, to think about it for a second, it's not easy, right? You got to set up some kind of portal, where people can go and apply, and then they got to give you records on their income. Landlords have to participate. There's all kinds of issues, just nitty gritty kind of issues involved in, cutting a check to a landlord to help for back rent. And so it's not going so well. So I don't know. I think this is going to be tough for them to, really get that money out quickly. So another reason to be a little nervous about that for sure. Yeah.
Yeah.
Okay, I'm cognizant of time. We have been chatting, and my wife is peering through the door here saying, what's going on? She's been making sure the dogs don't bark.
Mine's
good job,
texting
honey.
me.
Great job. Great job.
My wife is texting me if we're done yet.
Oh, is that right? Okay. Okay. I think we should, Marisa, anything else you want to add here that we missed? Okay. Very good. Pardon me?
No.
Okay. All right. Very good. And have you noticed Chris has also gotten into emojis recently? Nothing but
Yes,
emojis.
I have noticed that.
I'm all into the emojis. I resist for a long time. But,
Emoji maven. Actually, my wife, she's over here looking at me. She is the emoji maven. She could really help you out, Chris, on what emojis you should be using. If you're interested.
That's great.
Thumbs up. Okay, very good. All right, we're gonna call it a podcast. Thanks, everyone. Take care. Talk to you next week.